the Fed has kept interest rates higher for longer, meaning the length of time from its last rate hike to the first cut. And you can see we're above average now. And you can also see the last 3 times this happened, when we were higher than even we are now, was a harbinger of the 08-09 global financial crisis. So that was 06-07. It was a harbinger of the tech and telecom bust in 97-98. And in 1969-70, it was the harbinger of a recession.
Cathie Wood, the visionary founder, CEO, and CIO of ARK Invest, sheds light on the difficult period we are living in within the constantly changing world of global finance. Cathie analyzes the complex relationship between governmental actions and their seismic effects on the globe. Cathie guides us through the maze of uncertainty, with an emphasis on innovation, as the lighthouse leading us through choppy waters against the backdrop of governmental monetary policies that are on the edge of instability. This episode explores the complexities of the Bitcoin halving, the M2 money supply, and the critical role that innovation plays in the face of unstable global economies. Yassine Elmandra, Director of Digital Assets at ARK Invest, is a renowned guest who joins Cathie in contrasting the supply of Bitcoin, which is guaranteed by mathematics, with the unpredictable actions of central banks throughout the globe. Cathie's observations cut through the clouds of doubt and caution against the dangerous course of further tighter monetary policy. She issues a warning about the Federal Reserve's unshakable commitment to raising rates, predicting terrible fallout that is evocative of previous financial crises. Let's hear what she has to say.
This halving chart is, you can see the discipline here, as Yassine said, it's been mathematically metered, and actually we did a Bitcoin brainstorm with miners. And I think Yassine's going to tee that up in a minute. But this monetary policy basically was written in 5 lines of code. I did not know that until we did that Bitcoin brainstorm. It is so elegant, so simple, so straightforward. So in contrast, take a look at this. All right, this is M2's M2 growth, and it's a 4-year annualized percent change. So from March this month to March, or this past March to March 4 years ago, what is the monetary growth rate at an annual rate? That would be the last data point here, which is, you can see the black dash line. So that rate is about 8%. And actually, probably it's closer to 6%. There's a lot of data on this chart. But take a look at the 4-year growth rate of M2. And you can see it's all over the place. You can see in the 60s and 70s, it moved toward double digits, and we ended up with double-digit inflation in the late 70s, early 80s. It took a while to get there, and it seemed to be very sticky. And then after Chairman Volcker came onto the scene, I think that was 1979, he said, we have to get this thing under control. And he started choking money supply. And that momentum actually continued into the mid-90s. And then in the mid-90s, it's very interesting because it's somewhat similar to today. In the mid-90s, there was a domino effect of currency devaluations around the world. Our monetary policy was propagating throughout the world because it is the world's reserve asset. And the first devaluation actually was Mexico. And it was a big one. I remember it very clearly because we were involved with Mexican stocks. And then a few years later, we had the Asian domino effect. I think the Thai baht devalued in 1997, and then the rest of Asia's currencies devalued. We had the Russian default in 1998, and then we had long-term capital falling apart. Monetary policy propagates through the system, and when it's so unpredictable, it leads to all kinds of excesses. And so what do we have now, where we see what happened because of COVID? That drove the 4-year annualized growth in M2 up to 12%. And then now we've had a very sharp deceleration, unlike the 70s, 60s and 70s, where there was sort of an acceleration, at least in the sense of a trend, and a stabilization near double digits. Here we had money thrown at the system to prevent an outright depression. And if by the end of the year we stabilize around 0% year-over-year growth, that's year-over-year, this line will drop toward 2 to 3%, which, as you can see, we've only seen once. It was in the 90s, and after that, all hell broke loose around the world.
Cathie is warning us about the Federal Reserve's unshakable commitment to keeping interest rates low. The already precarious position of economies throughout the world is being made worse by this demand. At least 3 currencies have had notable devaluations of 40% to 60% versus the US dollar in the last year alone. Consider the Egyptian pound, which has lost more than 2/3 of its value compared to the US dollar as a result of many devaluations that have occurred since early 2022 and were brought on by a worsening lack of foreign exchange. Both the Argentine peso and the Nigerian naira, which have seen significant devaluations in recent months, are in equally bad shape. Fortunately, those in these countries with internet connection have resorted to Bitcoin, effectively purchasing protection against the continuous depreciation of their weak fiat currencies. Millions of people in developing nations now have a lifeline thanks to this action, but the effects are not limited to developing nations. Cathie worries that things are about to become worse since even established economies are starting to show symptoms of trouble. In the next video clips, Cathie delves deeper into her observations as she examines these crucial concerns.
We're in a very interesting environment, and it's caused by monetary instability around the world. And so I often talk to Yassine about these devaluations. And of course, in emerging markets, anyone with a connection to the internet now pretty much can establish or buy an insurance policy in the form of Bitcoin, which, just flipping back to the halving in this purple line, doesn't look anything like the volatility you see in monetary policy here in the United States and around the world. And of course, it's controlled by human beings. When we went off the gold exchange standard and closed the gold window in the United States in 1971, monetary policy just became unhinged, and it has been unhinged ever since, although human beings have tried to contain the inflationary ramifications, and they take it too far both ways. And right now, we think they're taking it too far on the downside. Here's the real Fed funds rate. So the Fed funds rate is roughly 5.5%, and 5 to 5.5%. And you can see the minus 3% gets us to 2.5% there. If inflation does come down the way we expect, and the Fed does not cut rates, which the markets now don't expect one until November, if they don't cut as inflation's coming down, then this line is going to go out closer to 5%. Again, we haven't seen that really since the 80s, when inflation was still considered embedded or at risk of going back to double digits. We're nothing like that today. On the next page, this slide is how long the Fed has kept interest rates higher for longer, meaning the length of time from its last rate hike to the first cut. And you can see we're above average now. And you can also see the last 3 times this happened, when we were higher than even we are now, was a harbinger of the 08-09 global financial crisis. So that was 06-07. It was a harbinger of the tech and telecom bust in 97-98. And in 1969-70, it was the harbinger of a recession. Just a quick note on fiscal policy. You can see the deficit. We present this each time, and just want to reinforce that the antidote to this deficit, which in a so-called expansion is at 6.5%, that really has not happened except in the aftermath of the 08-09 meltdown, while stimulus was still flowing freely in response to it. But we're not in such a meltdown now, and we do believe growth is going to be the solution, as it was in the 90s. You can see the 90s in the Clinton administration for the most part. We ended up back in a surplus, which was a function of the very good growth.
Cathie Wood draws attention to the complex network of problems with the economy that result from unstable global money. She goes into the concerning trend of currency devaluations, which is more noticeable in emerging markets, and highlights how Bitcoin's inherent stability makes it a promising hedge against these swings. Cathie presents an extreme contrast between the deliberate halving of Bitcoin and the unpredictable nature of conventional monetary policy. She highlights the ongoing battle to temper inflationary forces by pointing out the substantial change in monetary policy since the U.S. left the gold standard in 1971. Cathie expresses concern and cautions against the possible consequences of implementing too strict monetary policy. Assuming that inflation declines as anticipated, she contends that if the Federal Reserve does not cut interest rates, they may rise to levels not seen since the 1980s, indicating a fresh danger of inflation. Cathie shows the historical trend that long stretches of high interest rates have frequently preceded notable economic downturns by looking back at previous examples. She issues a warning, pointing out that the tightening monetary policies that define the current economic environment have uncanny similarities to past disasters. Cathie's study, taken as a whole, provides a dark assessment of the state of the world economy, pointing out the vulnerabilities caused by monetary instability, as well as the possible hedging provided by Bitcoin. She further argues that fiscal and monetary policy should be balanced, highlighting the necessity of sustainable growth in order to successfully navigate the complexity of the contemporary economy.